Good day everyone! We are the group 1 and we are here to discuss the topic from chapter 13, the principles of deductions. But before we formally start our discussion, allow me to introduce to you our presenters. First on the list, we have player 456, Joe Fracasio, player 067, Novelin Agdara, player 046, Yola Belakino, player 007, Maxel Asuncion, player 143, Donna Balingatan. We have also our player 001, JR Balmores, player 365, Georgie Bibat, player 218, Joanna Baribueno, and the last on the list, player 437, John Vincent Buraga. And now let's start our discussion. So after this session, we are expected to know the detailed concept of business expense and the different accounting procedures used to account for expenses. And also, we're able to distinguish the general principles of deductions from gross income. Once again, these are our learning objectives for the topic. Moving on, deductions from gross income pertains to business expenses incurred by a taxpayer engaged in business or engaged in the practice of profession. When we say business, it means habitual engagement in commercial activity involving the regular sale of goods and services to customers or clients. But in taxation, generally, the term business also includes the exercise of a profession. And we should know that self-employment is a business, but employment is not. It is important also to know what is the difference between business expense and personal expense. Business expenses are costs of doing trade, business, or practice of profession, while personal expenses includes the living and family expenses of the individual taxpayers. Take note, only the business expenses are deductible. The 250,000 annual income exemption in the tax table for individuals is deemed in lieu of all personal expenses of individual taxpayers. Hence, personal expenses are non-deductible. If these expenses are intended for both business and professional use, these two expenses are allocated between the two, and only those that pertain to the business are deductible. Let's say, for an instance, a taxpayer borrowed money from a bank and used 60% of the proceeds to finance the construction of his house and the remaining 40% as working capital for his business. He later paid 10,000 in interest. Therefore, only the 60% of the interest expense, which is equivalent to 6,000, shall be considered as personal expense, while the 4,000, which is the 40%, will be considered as business expense. Next, a taxpayer is engaged in trading business and he is renting a 2-story warehouse a month that costs 40,000. This taxpayer used the lower floor to store merchandise and he used the upper floor as his residence. So in this case, half of the rent pertaining to the lower floor is a business expense, while the other half of the rent is personal expense. Moreover, after we distinguish business expense versus personal expense, let us now differentiate business capital expenditure from business expense. Business expenses are beneficial only to the current accounting period. These are costs of generating income or gains for the current period. Hence, they are deductible against gross income in the current period. And these are the examples. On the other hand, capital expenditures are expenses that benefit future accounting periods. These are initially recorded as assets upon acquisition, then later deducted against future gross income when used in the trade, business, or profession of the taxpayer. It must be noted that the advanced deduction of capital expenditures is not warranted as it contradicts the lifeblood doctrine, and these are its examples also. Property, plant, and equipment pertain to all types of properties used or reserved for use in the business of the taxpayer, such as land and depreciable properties, which decrease its value by the passage of time, and includes building, machineries and equipment, furniture and fixtures, and so on and so forth. While inventory includes merchandise that is intended for sale, and investments, which are assets that is purchased intended to earn from appreciation in value or for accrual of income such as dividends and interest. Furthermore, the acquisition of intangible assets such as patents and franchises constitutes capital expenditure that must be amortized over the period they are expected to be used. In addition, the expenses incurred also to create or maintain some form of goodwill for the taxpayer's trade or business or for the industry or profession of which the taxpayer is a member are non-deductible. These expenditures are expected to benefit future periods. Hence, they should be amortized over the period of years during which the benefits of the expenditures are realized. And for the rentals on a finance lease or capital lease that transfers ownership at the end of the lease term are not considered expense. The acquisition costs of the leased property are initially capitalized and subsequently depreciated throughout the useful life of the property. But all of the other finance leases under GAAP, the rental payments can be considered as expenses for tax purposes.
Good day everyone, I am Novelin Saladino Agtarap and I am tasked to discuss the rules on deducting capital expenditures on the part of PPE. It is mentioned that one of the examples of capital expenditures is property, plant, and equipment. Property, plant, and equipment pertains to all type of properties used or reserved for use in the business of the taxpayers. Property, plant, and equipment is classified into two, the non-depreciable and the depreciable properties. Non-depreciable asset. Non-depreciable asset pertains to those that do not decrease in value by usage or by passage of time, such as land. The cost of the non-depreciable asset is deducted against the selling price when sold. Depreciable properties. Depreciable properties pertains to those that decrease in value by usage or by passage of time, such as land improvements, leasehold improvements, building improvements, building, machineries and equipments, and furnitures and fixtures. The depreciable cost of the asset is allocated over the useful life of the asset. How do we compute the depreciable cost? Just simply deduct the salvage value to the cost of the asset. Useful life and depreciation rate. The useful life of the property is the length of time it is expected to be serviceable or its legal life if applicable, whichever is lower. Under Section 34 of the National Internal Revenue Code, the taxpayer and the Commissioner of Internal Revenue may enter into a written agreement on the estimated useful life and rate of depreciation of any property. Such agreement shall be binding on both the taxpayer and the government in the absence of facts and circumstances not taken into consideration during the adoption of the agreement. Any change in the agreed rate and useful life shall be applied prospectively starting on the taxable period when notice by certified mail or registered mail is rendered by the initiating party to the other party. Next to discuss are the different depreciation methods. There are 4 different depreciation methods and the taxpayer may choose from the following: straight line method, sum of the year's digit method, declining balance method 150% or 200%, and the other methods which may be prescribed by the Secretary of Finance upon the recommendation of the Commissioner of Internal Revenue. Straight line method. Under this method, the depreciable cost is simply spread equally over the useful life of the asset. The annual depreciation expense is computed as the acquisition cost less salvage value divided by the useful life in years. I prepared an illustration for us to understand the topic more. On January 1, 2021, a taxpayer acquired a 1 million building with 250,000 salvage value at the end of its 4-year expected useful life. Note, the cost is 1 million, the salvage value is 250,000, and the useful life is 4 years. So we have an annual depreciation expense of 1 million is 250,000 divided by 4 years. Kaya nakuha yung 187,500. For the book value, deduct the cost to the accumulated depreciation expense. For year 2021, the book value is 812,500 kasi 1 million less 187,500. You get 812,500. For year 2022, the book value is 625,000. 1 million less the accumulated depreciation na 375,000. Paano nyo kuha yung 375,000? May depreciation expense na 187,500 sa year 2021. And then sa year 2022, 187,500 ulit. Pag-plusin mo yun, makukuha yung 375,000. Tapos, the same process para sa 2023 and then 2024. The book value is referred as the adjusted tax basis. And the book value at the end of the useful life of the asset shall equal to the salvage value. Kung mapapansin nyo sa year 2024, yung book value natin nag-equal sa salvage value. Sum of the year's digit method. Under this method, the depreciation is computed by applying a series of fractions to the depreciable cost of the asset. A fraction is derived by dividing the asset remaining useful life by the sum of the digits in the life of the asset. We can also use the formula n times n plus 1 divided by 2, where n is the useful life of the asset. Illustration, on January 1, 2021, a taxpayer acquired a 1 million building with 250,000 salvage value at the ends of its 4-year expected useful life. For year 2021, the depreciation expense is 300,000. Paano nakuha? 750,000 yung depreciable cost natin times 4 over 10. The divisor is 10 kasi asset has a useful life of 4 years, so 4 plus 3 plus 2 plus 1 is equals to 10. The dividend is 4 kasi yun yung remaining useful life for 2021. So, for the book value, meron tayong 700,000 kasi 1 million less depreciation expense na 300,000 equals 700,000. For 20 ganun ulit, 750 times 3 na lang yung gagamitin na dividend kasi yun na lang yung remaining useful life for 2022. So, the depreciation expense for 2022 is 205,000. The value is equals to 475,000 because 1 million less 300,000 less 225,000, we will get 475,000. Kung mapapansin nyo ulit, for the year 24, the book value equals to the salvage value. Declining balance method. Under this method, the depreciation is computed by applying a fixed rate on the asset carrying amount. Note, it's the asset carrying amount, not the asset depreciable cost. Also note that in declining balance method, the salvage value is initially ignored in computing the depreciation expense, but it is considered in the terminal year of the property. When to compute for the depreciation rate when using 150% declining method, use the formula 1.5 divided by the useful life of the asset. To compute for the depreciation rate when using double declining method, use the formula 2 divided by the useful life of the asset. We have an illustration using the 150% declining balance method. On January 1, 2021, a taxpayer acquired a building worth 1 million with 100,000 salvage value at the end of its 4-year expected useful life. For this illustration, we have a depreciation rate of 37.5%. 150% divided by useful life na 4 years kaya nakuha yung depreciation rate na 37.5%. For year 2021, the depreciation expense is 375,000. Paano nakuha? 1 million na carrying amount multiply 37.5% na depreciation rate. Book value at year 2021 equals 625,000. 1 million na carrying amount less the depreciation expense na 375,000 kaya nakuha yung 625,000. For year 2022, ang carrying amount na lang is ng building is 625,000, the book value at the year end of 2021. We also have an illustration using the double declining balance method. On January 2, 2021, a taxpayer purchased an equipment for 500,000 which is estimated to last for 5 years with 50,000 salvage value. For this illustration, we have a depreciation rate of 40%. 2 divided by 5 years magre-result sa depreciation rate na 40%. For year 2021, the depreciation expense is 200,000. Paano nakuha? 500,000 carrying amount of the equipment multiply by 40% na depreciation rate. For year 2021, the book value is 300,000. Paano nakuha? 500,000 carrying amount less depreciation expense na 200,000. Kung mapapansin nyo, sa year 2025, hindi na natin ginamit yung depreciation rate na 40% kasi kapag ginamit pa natin iyon, yung book value natin is lesser than the salvage value. Recall that the provision of depreciation expense for the terminal year shall not result in a tax basis less than the salvage value of the asset. Other methods which may be prescribed by the Secretary of Finance upon recommendation of the Commissioner of Internal Revenue is the fourth method for depreciation. Disposal of properties before full depreciation. If the property is disposed of before it's get fully depreciated, its book value is deducted against the selling price. The difference is either a gain or a loss. But if the property is destroyed, its book value is recognized as an ordinary loss.
Shalom ma'am, shalom everyone. I am Yolabel Krisha Aquino, and I will present the other rules on deducting capital expenditures, which are intangible assets, inventory, and prepaid expense. Intangible assets or non-monetary assets with no physical substance have two types according to its useful life. Finite useful life or intangible assets that loses their value over time can be amortized over the shorter of its useful life and legal life, if any. For example, patent. Patents have a legal life of 20 years. Therefore, patent is amortized over the shorter of its useful life and 20 years. If the intangible asset was computer software, which do not have legal life, then it amortized over useful life. Indefinite useful life or intangible assets that do not lose their value shall not be amortized. Inventory. Costs are deducted when sold or used using inventory method or specific identification method with the aid of point of sale machine. We have an illustration here that uses inventory method. Note that the cost of goods sold shall be include the purchase price or cost to the merchandise and all expenses directly incurred in taking them to their present location and use. The illustration example was for goods inventory only. What if supplies or tools are given? Well, the same computational procedure is employed, but the resultant figure is referred to as supplies expense. Note, expensing cost of purchase of inventory or supplies normally does not properly reflect the income of the taxpayer unless the fluctuation in inventory level is immaterial. This may expose the taxpayer to risk of income recomputation and assessment by the CIR. The presentation in the income tax return, cost of goods sold is deducted from gross sales to measure gross income from the operation. Prepaid expense. Prepayments are deducted in the future periods as they expire or as they are used in the business or profession of the taxpayers. Note the words deducted in the future periods because advance deduction, if material, is not allowed for it will cause significant distortion in net income. Let's read the illustration. In 2018, Zephyra Incorporation paid $300,000 as a 3-year advance rental for the lease of building to commence 2019 through 2021. To close the lease contract, Zephyra also paid the lessor a lease bonus of $30,000. A lease bonus is not expense but a prepayment that should be amortized together with the $300,000 prepaid rentals. So, $300,000 plus $30,000 equals $330,000 divided by 3 years is $110,000. The $110,000 should be amortized as the annual rent expense of the 3 years. So now, let's move on immaterial capital expenditures. Immaterial in amount may be deducted outright as expense upon acquisition as this will not materially distort net income. Example was items of PPE, inventories, prepayments that immaterial in amount. Here, inventory method may impractical to use for such item. And that's wrap up my topic.
Now let us proceed to the different special considerations with deductions, which are the property repairs and improvements, property acquisition related costs, securities issue costs, manufacturing expenses, effects of accounting methods, and lastly the effects of value-added tax. First is the property repairs and improvement. Repairs that significantly increase the value or prolong the useful life of properties are capital expenditures. These are capitalized to the adjusted tax basis of the property and are included in the subsequent annual provision for depreciation. Repairs that merely restore the value or functionality of the property without causing increase in fair value or useful life of the property shall be deducted as outright expense. Take note that if the fair value of the property increases due to repairs, improvements, or additions, the actual cost of the repairs, improvements, or additions should be capitalized not to exceed the appreciation in the fair value. If the fair value of the property is not determinable, the excess of the actual repair cost over the tax basis of the property is presumed a capitalizable increase in fair value. Also, if improvements and additions to properties normally increase the life of properties, hence these are capitalized and depreciated. Here are some illustrations. The building of B Corp with a carrying value of 1 million pesos was partially dilapidated through long usage. A repair of 500,000 was made on the property. In case number 1, there is no increase in property value or useful life. Therefore, the 500,000 repair is deductible as repair expense. The tax basis of the property remains at 1 million pesos. In case number 2, property fair value increased to 1,800,000 pesos after the repair. Then, the entire 500,000 repair is capitalizable since it is less than the 800,000. Appreciation in fair value. The adjusted tax basis of the property for purposes of future provision of depreciation expense shall be 1,500,000 pesos. In case number 3, property fair value increased to 1,400,000 pesos after the repair. The 500,000 pesos repair cost shall be capitalized only to the extent of the 400,000 increase in fair value. The excess 100,000 repair cost is expense. The adjusted basis of the property for future depreciation shall be 1,400,000 pesos. In case number 4, 1,200,000 repair cost was made to restore the property. Fair value after repair is unknown. 1 million pesos is deductible as repairs expense while the excess 200,000 is capitalizable improvement. The adjusted tax basis of the property shall be 1,200,000 pesos. Also, the same principles apply in case of repairs of properties due to partial destruction by fire, storm, and other calamities except that the deductible repair cost is presented as a loss. In case number 5, no increase in fair value but with increase in useful life. Therefore, the 500,000 will be capitalized. The adjusted basis for the future depreciation shall be amounting to 1,500,000 pesos. Addition to the property repairs and improvements is the replacements of old or destroyed properties. The tax basis of the old property is deductible as a loss, but the cost of the replacement property is capitalized subject to future provisions for depreciation. For example, the office building of Asuncion Corporation with a carrying value of 4 million pesos was totally destroyed by an earthquake. The same was replaced with a new building at a total cost of 8 million pesos. Therefore, the 4 million pesos is deductible as loss, while the 8 million pesos is capitalized as the tax basis of the new building subject to future provisions for depreciation. Cost of demolishing old buildings. When land was acquired with an old building in it but was not intended to be used by the buyer, the entire amount paid is assigned only to the land of demolishing the old building. Net of any salvage scrap are treated as additional cost of acquisition of the land. The cost of raising or removing an old building to give way to the erection of another in its place is not a deductible expense but capitalized as part of the cost of the replacement building. Here's an example. Determined to the insufficient for business use, the 3-story building of Primo Corp was decided to be replaced by an 8-story building. The 3-story building with a 1,500,000 carrying value was raised at a cost of 600,000. A 9-story building was constructed in its place for 12 million pesos. Therefore, in this illustration, the 1,500,000 carrying value of the old building shall be deducted as a loss. The cost of the 9-story building shall be 12,600,000 inclusive of the demolition cost of the old building. To the second one, which is the asset acquisition related cost. All costs directly related to the acquisition of an item of property, plant, and equipment such as in-transit insurance, title guarantee insurance, freight, finder's fee or commissions, import duties, and other taxes are capitalized as part of the cost of the property subject to depreciation. Expenses incurred which are directly related to the acquisition of goods such as transportation, broker's commission, insurance in transit, including those incurred in bringing the goods for sale such as consignment, freight out, are capitalized to the cost of the goods and are expensed through cost of goods sold when sold. Cost of financing asset acquisition may adoption of the taxpayer, be expensed outright or capitalized and depreciated. The third one is the security issue costs. Expenses of issuing equity or debt securities such as cost of registering shares of stock to the Securities and Exchange Commission, cost of printing bond or stock certificates, or broker's commission on selling stocks or bonds are not deductible expense against gross income. They are deducted against the proceeds of each security. The proceeds of such securities. The third one is the security issue cost. These are expenses of issuing equity or debt securities, such as cost of registering shares of stock to the Securities and Exchange Commission, cost of printing bond or stock certificates, or broker's commission on selling stocks or bonds are not deductible expense against gross income. They are deducted against the proceeds of such securities.
Moving on to the manufacturing expenses, Plant or factory expenses such as cost of raw materials, supplies used, labor, and other overhead like plant utilities, maintenance and security, supplies, and depreciation are capitalized as part of the cost of the goods being processed and are expensed through the cost of sales when sold. So basically, manufacturing costs are the costs incurred during the production of a product. These costs include the cost of direct material, direct labor, as well as the manufacturing overhead. So, moving on to the formula in computation of the manufacturing expenses, the calculation for total manufacturing cost involves a detailed accounting for the cost of materials, labor, as well as the overhead. It requires a realistic analysis of a company's various departments to show their contribution to the manufacturing process and the cost of those contributions. As you can see in the slide, with that using the formula stated in the slide, afterwards, after performing and following that formula, by then, you should be getting the cost of goods sold for the direct cost of producing the product. So, non-manufacturing cost or the administrative and selling expenses should be expensed as incurred or paid depending on the accounting method adopted by the taxpayer. The non-manufacturing costs include those costs that are not incurred in the production process but are incurred for other business activities of the entity. These costs do not specifically contribute to the actual production of goods but are essential to ensure the overall functioning of the business. Moving on to the manufacturing cost, these should not be expensed outright but are capitalized to inventory, then expensed through the cost of goods sold. Then, cost of goods sold is deducted against sales to determine the reportable gross income from operation. As for the effect of accounting method of deduction, the method adopted by the taxpayer in accounting for expense have a significant bearing on the deductible expense. It must be recalled that under cash basis, expenses are deductible when paid regardless of when they incurred, while under the accrual basis, expenses are deductible when they are accrued regardless of when they are paid. However, prepayment and capital expenditure cannot be deducted outright. All individuals and business taxpayers are required to pay taxes on their income every year. A consistent accounting method must be used to report income and taxes for any given tax year. The two accounting methods used by taxpayer in reporting income are the accrual method and the cash method. So, first thing first, we will be talking about the cash basis accounting. So, what is cash basis accounting? A cash basis accounting is taxpayer reports income and deductions in the year that they are actually paid or received. A cash basis taxpayer reports income and deduction expenses in the year they are paid off, which is not necessarily the year they are incurred. This method does not recognize account receivables or the account payables. Just note that accrued expenses are not deductible under cash basis. Capital expenditures and prepaid expenses cannot be deducted in the current period but in the future period they relate to. So the formula to get the deductions on the cash basis would be cash expenses paid, addition to amortization of prepayments, as well as the depreciation of the properties. By then, you will be getting the sum of the cash basis for your deductions. And as for the accrued basis, Income are reported already earned, and expenses are reported when incurred regardless of when these incomes are received or paid. For example, you would record revenue when a project is complete rather than when it's paid. Just note that with the accrued basis, accrued expenses are also deductible. Prepayments and capital expenditures items such as costs of equipments, the acquisition, related freight cost, and the prepaid expenses are excluded. So the formula for the computation of deductions on accrual basis is accrued expenses paid or unpaid, addition to the amortization of prepayment and depreciation of properties. By then, you will be getting the total amount for the accrued basis deductions. Moving on to the treatment of input VAT. For VAT taxpayers, the input VAT is claimable as tax credit against output VAT. It is not claimable as deductions. But for the non-VAT taxpayers, the input VAT is part of the cost of the purchase or expense of the taxpayer. Hence, it is claimable as deductions.
Hi everyone, let me continue the discussion. On deductions from gross income, there are what we call 4 general principles that we consider whether a specific expense can be deducted or not in the computation of taxable income. The first principle that I will be discussing is that an expense should be legitimate, ordinary, actual, and necessary, or the acronym loan principle. Its name doesn't literally mean about a debt in a bank, rather it was only shortened for us to remember it easily. Moving forward, let's discuss about legitimate or the letter L. In here, it considers some characteristics to be say so. First of which, should the business be incurred in current taxable period? Yes, it says here that current period and not on previous periods or future time. Another, it should not be a capital expenditure, meaning the expense should not form part of the funds used in acquiring a PPE or say those other directly attributable costs that are capitalizable upon acquisition of an asset. Next, should be related to the business or profession. If it's not related to the operations, then why include them, right? Another one is that expense should never be of contrary to the law or an existing public policy. The intention should be good and doesn't violate our law. Lastly, it should be adequately sustained. This will be discussed further. So we have to consider these 5 characteristics to determine that an expense is said to be legitimate. Here is an illustration. Say a taxpayer compiled the following payments. Okay, salaries of employees or the payroll 100,000, the repair and maintenance 100,000, renovation cost of an old building, the purchase of new equipment, the bribes to government officials, and this dividend distribution to shareholders. If we are asked to compute for the expense which are eligible to be deducted from gross income, it would only include the payroll and repair and maintenance. Why? Let's discuss this. It's because that the renovation cost and the purchase of new equipment are both capitalizable expenditures, meaning it could be deducted soon on the computation by means of depreciation, so only the value decreasing. Yes, another one is the bribing the government official. It's not also included since it violates a law. It's a bribery. And the dividend distribution is not an expense but a distribution of corporate profit. Okay, I hope it is clear. Next, from loan principle, we have the letters O and N. We separate here the letter A because it has a different discussion, while these two share the concepts that both should be fulfilled. Says here that an expense should be ordinary and necessary. By definition, ordinary generally means normally incurred related to business of the taxpayers and the surrounding circumstances, like when normally incurred among the same taxpayers under the same line of businesses. These, in other words, are anything that is common and accepted to a specific business. For example, the employee's compensation. When we say payroll, these are the amount we need to pay for the employees, for the services they rendered. Another one, the utilities expense. We can say that the business, when compared to other businesses, are all paying an amount for their utilities. So those two are examples. On the other hand, necessary means that an expense should be reasonable and essential to the development, management, and operation of the business. Yes, so a deductible expense must be both ordinary and necessary. For instance, when do we say that a travel expense is an ordinary and necessary? It is when it is incurred with a benefit in return for the business in generating an income. It became non-deductible when it is used for personal purposes and not related to the business. On next slide, okay, here a normal question is being raised, and this is what often we ask: when do we consider an expense as necessary? Is it reasonable for the business to incur a particular expense? The answer, according to the book, there is no fixed or clear-cut criteria because the burden of proof or establishing its validity rests upon the taxpayer. It lies on the person who pays rather than the tax authorities. This CIR versus General Foods Philippines Incorporated provided a criteria, but it stated here clearly that is not limited, meaning these are only what they see that must be considered. Number one of which is the type and size of business in which the taxpayer is engaged. For example, it is impossible for a business to incur an amount that is not relatable to the business. Number 2, the volume and amount of its net earnings. Of course, how could a business use fund when in the first place the entity could not cater such expenses? Meaning, it should be on the range of accepted ratio in relation to its net earnings. Number 3, nature of the expenditure itself. This was discussed a while back that an expense should be legitimate, of course. And number 4, the intention of the taxpayer. Why? Because entities are sometimes, or a business is willing to pay an amount but with bad intentions. It could be for personal interest, like that, but go against public policy, so it's wrong. And lastly, generally economic conditions. These 5 are only some. As I said, it's on common sense already that how dare should a business include an amount when it is not reasonable, right? This is what it means, because still the reasonableness of an expense rests upon the taxpayer and not on the taxing authorities. Okay, let's for the acronym. We have actual. What is meant by actual? Okay, here we say that it is actual when that expense is a result because an entity is obliged to pay to continue its operations. It says here that it means paid or resulted in an obligation of the taxpayer under closed and completed transaction. We'll discuss what is this closed and completed transaction as we go along. And continuing that if such loss exists, it should also be sustained or realized. For example, a fire burned a store on an entity and this entity has insured itself. We cannot say that property is not yet considered to be sustained in a closed or completed transaction. Why? Why? It's because another transaction will arise after the loss. It says here that a closed and complete transaction can only be achieved when no further transaction emanates from its occurrence. So, a fire loss on an insured property, we are expecting that there will be a final reimbursement. That's why it is not yet considered to be sustained in a closed or complete transaction. Another example, when a taxpayer incurred a loss on a lawsuit, we cannot consider it to be final until final judgment is rendered. Until such time that we could only consider it as a closed and complete transaction when final judgment is already been decided. Okay, in gist, here are the example of non-deductibles from this said principle. So it's like the summary. Number 1, a decrease in value of properties or investment which comprises a decrease in value of securities, a decrease in value of foreign currency, a decrease in value of machineries. These decreases on the amount of existing accounts are non-deductibles. Why? As we said that they are not reasonable as to how it is related on the generation of an income. It's not included in the normal operations. These conditions in general are economically factors but not in relation as an expense which the taxpayer became obliged due to previous transactions. Okay, number 2 are the estimated future losses, which includes estimates from bad debts or loss on lawsuits not yet confirmed. These go with the letter A, or the actual, that they are not sustained in a closed and completed transaction. Another point here is that we are not sure of when will we actually incur these losses, considering that we should see that it is incurred only during the current taxable period. And number 3, the losses on properties covered by insurance or indemnity contracts. This is what example that there is an expected or upcoming transaction after the loss on property happened. It says here that these losses are merely temporary and may be reversed until they become actually sustained upon final settlement of the insurer. This ends the first principle. Let's move on to the next one.
It is well-established rule in income taxation that only business expenses that are incurred for the generation of items of gross income subject to regular tax are deductible. This is a pervasive criterion that is consistently observed by the NIRC revenue regulations and BAR rulings. Let us refer to this rule as the matching principle. Examples of non-deductible expenses under this rule are expenses on exempt income, expenses incurred to finance the acquisition of a tax-exempt security, premiums paid for the life insurance of an officer where the taxpayer business itself is the beneficiary. The proceeds from such insurance arrangement is tax-exempt, hence the premium expense is not deductible. Expenses on FCDU or EFCDU from foreign currency operation. FCDU or EFCDU expenses from exempt operations cannot be deducted against the items of gross income subject to regular income tax. Lastly, expenses of non-profit organizations, government agencies, and cooperatives from their exempt operations. Expenses on income subject to special tax regime. Expenses of newly enterprises registered with the Tourism Infrastructure Enterprise Zone Authority under Republic Act 9593. Newly registered enterprises of the Tourism Infrastructure and Enterprise Zone Authority are subject to a 5% gross income tax in lieu of all other national and local taxes, license fees imposed, and assessment except real estate taxes, and expenses of enterprises registered with the Philippine Economic Authority. The expenses of these businesses in connection with their operations subject to the 5% gross income tax are non-deductible against their gross income subject to regular income tax. Business expenses of taxpayer subject to final income tax such as non-resident alien not engaged in trade or business and non-resident foreign corporations. These taxpayers are not subject to regular income tax, hence they cannot claim deductions of whatever nature. Expenses and taxes on income subject to final tax or capital gains tax. Selling expenses of domestic stocks directly to a buyer, selling expenses of real properties classified as capital assets, expenses of petroleum service subcontractors in supplying goods and services to petroleum service operators. Pursuant to PD 1354, the gross income derived by subcontractors with petroleum service contractors is subject to 8% final tax in lieu of any and all taxes, national or local. Foreign business expenses of taxpayers taxable only on Philippine income, such as resident aliens and non-resident aliens engaged in trade or business in the Philippines, and resident foreign corporations. Foreign expenses shall not be deductible unless the same are incurred in connection with their business in the Philippines. Lastly, loss of income not yet recognized in gross income. Write-off of receivable under the cash basis of accounting. Destruction of unharvested farm fruits and vegetables. and death of animal offspring.
The next principle of deductions is the related party rule. In this principle, gains realized between related parties are taxable, but losses are non-deductible. This is a control measure because transactions between related parties can easily evade tax responsibilities. This rule is relevant in the claim of losses, bad debts, and interest expenses. Moreover, according to the transfer pricing rule, non-arm's length expenses incurred between associated enterprises may be restated to their arm's length fair values to reflect the correct income of the associated enterprises, wherein a non-arm's length transaction occurs when the buyer and seller have a personal relationship or a deal between family, friends, or co-workers. Related parties refer to members of a family. This includes brothers and sisters, half-blood or full-blood, spouse, lineal ascendants and descendants. Next, the direct or indirect controlling individual of a corporation, except in cases of distribution in liquidation. A controlling individual means those who have an ownership of more than one half of the voting stocks of a corporation. Next, corporations under direct or indirect common control by or for the same individual, except in cases of distribution in liquidation. Grantor and fiduciary of any trust. Grantor of trust refers to the person who creates a trust, while fiduciary is a person or organization that acts on behalf of another person or persons putting their client's interests ahead of their own, with a duty to preserve good faith and trust. Fiduciaries of trust with the same grantor, and next, fiduciary of trust and the beneficiary of such trust. Here is an illustration of related parties between corporations. Mr. Lanao owns 60% of Misamis Corporation and 30% of Basilan Company. Misamis owns 70% of Compostela Company and 80% of Surigao Company. Compostela owns 55% of Cotabato Incorporated, while Surigao Company also owns 40% of Davao Company. In this, the related parties are indicated in bold font. Transactions between any of these taxpayers, either intercompany or involving Mr. Lanao, the ultimate controlling individual, are transactions between related parties. There being absence of control, Basilan and Davao are neither related between themselves nor to the group of affiliated corporations. In liquidation, all shareholders, related or unrelated, may realize actual losses on their investments. Hence, liquidation losses incurred from a related party are deductible. Let's proceed to the next illustration. Mr. Sarangani designated 3 trusts under management of different trustees. Trust 1 is in favor of Agus as beneficiary, while Trust 2 and Trust 3 are in favor of Kami as beneficiary. The trusts are irrevocably designated except Trust number 3. In this illustration, the fiduciaries of all the trusts are related to Mr. Sarangani. And also, the fiduciaries of Trust 2 and Trust 3 are related because the trusts they manage are for the same beneficiary. Agus is related to the fiduciary of Trust 1 but not to the fiduciaries of Trust 2 and Trust 3. And another one is Kami is related to the fiduciary of Trust 2 and Trust 3 but is not related to the fiduciary of Trust 1. Agus, Kami, and Mr. Sarangani are not necessarily related to each other unless they qualify as such as member of a family.
Good morning everyone, I am John Vincent Buraga from Group 1 of Bachelor of Science in Accountancy 2-2. So our group is reporting the principles of deduction, and in my turn, I'm going to report to you the withholding rule. So let us start. So in the withholding rule, payers of income are required to withhold income taxes on their payments. The failure to comply with this requirement shall result in the disallowance of the expense as deduction. So there's this rule wherein no withholding, no deduction. Let us proceed with the withholding taxes or the types of withholding taxes. There are three types, namely, first, withholding tax on compensation, second, final withholding tax, and third, expanded withholding tax. So I'm going to tackle it with you one by one so that you can further understand each type. So in the withholding tax on compensation, the expense type is compensation expense, while the BIR form is 1601C. The final withholding tax has the expense type of certain passive income and fringe benefits, while the BIR form is 619F. Lastly, the expanded withholding tax, the expense type is the other income payments which are subject to regular tax to the recipient, while the BIR form is 0619E. These three types of withholding taxes has the same deadline, wherein it is on or before the 10th day of the month following the month in which the withholding tax was made. So for EFPS fillers, the respective groups' deadlines apply. So let us now proceed with the summary of the withholding tax rate, or the summary of the expanded withholding tax rate. So for letter A, payments to suppliers of goods in general is 1%. For letter B, payments to suppliers of services in general is 2%, except there's this exception in the letter B. So let's go over with it one by one. First, rentals of properties or films to toll fees or refineries is 5%. Second, professional services to individual professionals, brokers, agents, or entertainers is 5% or 10%. Professional services to corporations is 10% or 15%. And professional services to general professional partnership is 10%. The third exception in this letter B is the embalmers by funeral companies is 1%. Fourth, additional payments to government personnel from importers, shippings, and airline companies or their agents for overtime services is 15%. The letter C of the summary of expanded withholding tax rate is the income distribution by these two. The first is the state and trust to heirs and beneficiaries is 15%, while the income distribution by general professional partnership to partners is 10%. The last is the payments made by credit card companies is 1% or one half or 1%. So for the purposes of withholding tax on professional fees, professionals must submit a sworn declaration that his gross receipt do not exceed 3 million pesos in a year. The same shall be the basis for the withholding tax agent to deduct 5% instead of 10%. So if you present a sworn declaration that your gross income does not exceed 3 million pesos in a year, instead of 10% deduction, the deduction will be only 5%. But if the professional is a VAT taxpayer, or if he fails to submit this sworn declaration, he shall be deducted the 10% withholding tax. So this is what I've said a while ago. So if you want to be deducted by 5%, you must declare a sworn declaration that your gross receipt does not exceed 3 million pesos in a year, the withholding tax. So let us now proceed with the illustration. So the first illustration is the expanded withholding tax if it is a non-VAT supplier. So let us read the illustration. In January 2021, Mrs. Arias is due to pay 40 pesos monthly rental expense to a non-VAT lessor. Mrs. Arias shall withhold 2,000 pesos computed as 40% or 40,000 pesos times 5% is 2,000. So Mrs. Arias shall withhold 2,000 pesos computed as from the rent, pay 38 pesos to the lessor, and furnish him a copy of BIR Form 2307. Mrs. Arias shall file BIR Form 06109E and remit the 2,000 pesos withheld tax to the government through an authorized government depository bank. Mrs. Arias shall use the BIR Form 0619E as support from her claim to itemize deductions. The lessor shall also use the BIR Form 2307 as tax credit against his tax due. So we have the illustration to wherein if the supplier is a VAT supplier in the way the expanded withholding tax. So in March 2021, Genesis Realty Corporation or GRC is a VAT taxpayer. He is about to pay 896,000 commission to Mr. Galante, wherein Mr. Galante is a VAT registered realty broker. So GRC shall deduct 10% withholding tax on the gross income of Mr. Galante. The withholding tax and the VAT of the payment shall be computed as follows. So the gross amount due wherein the 896 commission of GRC is this, and we are going to less the output VAT wherein it is computed as the 896 times 12 over 112. So that is 96,000. So the commission income now is 800,000 because we deducted the 896,000 to 96,000. So with this 800,000 commission income, we are now going to multiply the withholding rate, which is the 10% rate. So 800,000 times 10%, the final or the withholding tax now is 80%. So GRC shall claim the 800,000 pesos as commission expense and record the 96,000 as input VAT. The input VAT is a tax credit and is not an expense. So the cash payments to Mr. Galante shall be commission income 800,000 plus VAT the 96,000 less withholding tax 80,000, and the net cash due to Mr. Galante is now 816,000 pesos. So in accounting books, this is recorded as debit commission expense 800,000, debit input VAT 96,000, credit cash 816,000, and credit withholding tax payable 80,000. But if GRC is a non-VAT taxpayer, it can claim the commission and the VAT or 896,000 as deductible expense. GRC shall furnish Mr. Galante a copy of BIR Form 2307 since this is the third month of the quarter. GRC shall include the commission expense on its 1601 EQ or quarterly remittance return of creditable withholding taxes and remit the 80 pesos withholding tax to the BIR. So let's proceed with the illustration 3, the final withholding tax. So in June 2021, Dell Publishing incurred 200,000 pesos royalty expense to author attorney Policarpio Galemo. So Dell Publishing shall deduct 20,000 pesos or the 10% income tax from the 200,000 pesos royalty expense. So and then pay another 180,000 pesos and furnish her a copy of the BIR form of 2306. Since this is the third month of the quarter, Dell Publishing shall include the royalty payments in its BIR form 1061 FQ and remit the 20,000 pesos withheld tax to the government. Dell Publishing shall keep the BIR form 1601 FQ to support its deduction for royalty expense, but Galemo cannot use the BIR form 2306 furnish her as her tax credit because the royalty is not part of his gross income subject to regular income tax. So let us now proceed with the timing of withholding. Per RR 12/2001, the obligation of the payer to deduct and withhold tax from the income payment arises upon the occurrence of any of the following, whichever comes first. So first is payment, next is when the income payment becomes due or payable, and lastly, when the recording of the income payment as expense or asset in the books. But to avoid penalty, the withholding agent must remit the withheld tax before the deadline. So there's this late payments of withholding taxes. Under the rule established by RR 6 2018, the BIR held that expenses will still be deductible even if the withholding tax surcharge, including interest of such late withholding, is paid at the time of an audit, investigation, or investigation. This is a reversal of the previous rule that no deduction is allowed even if the withholding tax and penalties is subsequent paid. For income payments exempt from withholding tax, such as salary payments to minimum wage earners, the taxpayers must comply with certain documentary requirements of the BIR. So let us proceed to the penalties for non-withholding or late remittance of withholding tax. Non-withholding or late remittance of withholding tax is subject to the same penalties for the late filing or late payments of tax discussed under Chapter 4. So we have here the integrated illustration for the penalties for non-withholding or late remittance of penalties withholding tax. On March 15, 2021, the taxpayer paid 475 pesos net rental to a lessor but failed to remit the 25,000 pesos withholding tax to the government. The taxpayer filed the BIR Form 0619E on June 28, 2021. So the total amount to be paid by the taxpayer on June 28, 2021 shall be, let's compute this by the following. So withholding tax due 25,000 plus the penalties. So the penalties are the surcharge, wherein it is computed as 25,000 times 25%. So that's 6,250 pesos plus the interest, 25,000 pesos times 12% times 75 over 365. That's 649 pesos, and the compromise of 10,000 pesos. So if we are going to add all those followings, the total tax due now is 41,899. But note that the deadline for the withholding tax was April 10, 2021, the 10th day of the following month of withholding. Next note is that April 10, 2021 to June 28, 2021 is 79 days. So that's how we get the that's how we got the interest, the 79 days, because from April 10 to June 28 is 79 days. Lastly, the compromise penalty is taken from the table compromise penalty for failure to withhold or remit withheld tax at the time or times required by law as follows. So this is the table for the compromise penalty. So if the amount not withheld or remitted exceeds 25 or 15 pesos but not exceed 20,000 pesos, the compromise is 5,000. But if the amount not withheld or remitted exceeds 20,000 pesos but not exceeded 50,000 pesos, the compromise is 10%. Lastly, if the amount not withheld or remitted exceeds 50,000 pesos but not exceed 500,000 pesos, the compromise now is 15%. So that ends my discussion and explanation on the withholding rule.
For the period for which deductions and credits are taken, the deductions and credit provided for in this title shall be taken for the taxable year in which paid or accrued or paid or incurred, depending upon the method of accounting upon the basis of which the taxable income is computed, unless in order clearly to reflect the income of deductions or credits should be taken as of a different period. In the case of the death of the taxpayer, those taxable income is computed upon the basis of the accrual method of accounting. Amount includable in computing a partner's taxable income under Section 43 to 1412 accrued as deductions are and credits only by reason of the death of the taxpayer shall not be allowed in computing taxable income or the period in which falls the date of the taxpayer's death. As for the non-deductible expenses, knowing which expenses are fully deductible, partially deductible, or not deductible at all can be a real struggle. This is mostly because it all depends on the nation or the local legislation. Some countries or even states or companies will allow certain expenses to be deducted, while others will see them as non-deductible or any partially deductible. There are many expenses that are not taxable or deductible. Know the facts on what you can or cannot deduct on your return. Here are a list of expenses that the IRS generally considers non-deductibles. First thing first is personal, living, or family. That is included in the non-deductible expenses. Second would be the amount paid for new building or for permanent or betterment made to increase the value of any property estate, as well as any amount expended in restoring properties or in making good the exhaustion thereof. And last would be the premiums paid in any life insurance policies.
There are 4 tax reporting classifications of deductions. Number 1. The cost of sales or cost of services. Number 2. Regular allowable itemized deductions. Number 3. Special allowable itemized deductions. And lastly, the net operating loss carryover or known as NOLCO. Cost of sales or cost of services. It is the total of all costs used to create a product or services which has been sold in a particular accounting period. Under cost of sales, it is deducted outright against sales, revenues, receipts, or fees of individual taxpayers in the measurement of gross income from operations. Regular allowable itemized deductions. When we say itemized deductions, it refers to the specific expenses and other items that are deductible from gross income. Regular allowable deductions pertain to all necessary ordinary expenses paid or incurred during the taxable year, including directly attributable costs in carrying on the development, management, operation, and/or conduct of a trade, business, or exercise of profession. Expenses which are not directly related to the acquisition of goods or provision of services are included in regular allowable itemized deduction. These include administrative expenses and selling expenses. This will be discussed in Chapter 13A. Special allowable itemized deductions are additional deductions as provided under the NIRC or special laws. Special allowable itemized deductions can be categorized into 2 types: the actual compliance expense and the deduction incentives. Compliance expenses refers to the actual payments or transfer of funds, while deduction incentives are not actual expenses but are merely allowed by law to encourage taxpayers to support government program. This will be discussed in Chapter 13B. Net operating loss carryover pertains to the excess of expense deduction over gross income during a taxable year which is allowed by law to be deducted against the net income of the following 3 years. NOLCO is not an expense. It is a special deduction incentive allowed by law. Deduction incentives are deductible only in the year that they are billed, but is exceptionally allowed to be carried over 3 years. This will be discussed in Chapter 13B.
And for the last topic of this chapter, we have 2 modes of claiming deductions from gross income. First is the itemized deductions. Under this, taxpayers list every item of business expense they claim as deductions, and these deductions are strictly construed against the taxpayer. The claim for deductions must be supported with official receipts, payment vouchers, canceled checks, or other adequate records and documentations, and comply with any withholding tax requirements on expenses. Deductions claim must also comply with any applicable deduction ceilings set by law. And the second one is the optional standard deduction. It is in lieu of the itemized deductions, regular or special, including non-co. The deduction is merely presumed as a fixed percentage of gross income for corporations and gross sales or gross receipts for individuals. The rules of OCD will be discussed in detail in Chapter 13C. And that's the end of our discussion. On behalf of the Group 1, this has been Joe Fracasio. Keep safe everyone and thank you for listening.